So let me start off today's session. In terms of today's session, we will look at three main areas. First, let me talk about why, as individuals, we need to start thinking about retirement today. Two, how much we need to save today for us to achieve that retirement goal that we're looking at in 10 or 20 years' time. And how do we plan for retirement in terms of how do you allocate assets? What are the risks that we need to mitigate? How do we plan for the next generation? Are the three areas that we will be covering in this session. So the retirement equation has various parts to it, right? Some within our total control, some where we have some level of control, but partially we don't have control. And there are areas where we don't have complete control, no control as well. So the areas that we can control as individuals is A, how much we save and spend in order to get to the ultimate objective of retirement. Two, how we allocate assets and where we invest those assets is something that we can control. In terms of things that we can to somewhat control is the longevity of how we live, depending on our lifestyle and so on. There's a level at which we can decide on how our journey goes. And also, we have some control over employment, the duration that we work, even though there is a possibility of job losses and all that, and something that can happen in between, which can affect your life. And beyond our control are things like market movements, inflation, taxation, changes in policy, which can also affect your retirement in a big way, right? So we look at multiple parts of this equation in this discussion today, and I'll take a few questions towards the end in terms of some of the questions that you have. So let me start off with looking at the common retirement problems that individuals usually have and what they kind of fail to realize or misunderstood or underestimate, right? First and foremost, one of the largest things that people kind of neglect or fail to kind of get towards is figuring out how much they need in terms of savings that they need to have towards retirement, right? And that's 62% of the people or retirees who kind of face this issue in terms of not knowing how much to save for their retirement and what will comfortably make them to retire comfortably. The second important retirement pitfall or planning gap that people have is neglecting the threat of inflation, right? And the escalating health costs, right? So when you start off retiring, you think what you have is enough. But then when inflation kind of kicks in, health costs go at a faster pace, you have the issue of not being able to kind of keep up with that pace of inflation and health increases. The third part is failing to understand the risk and being able to strategically diversify. Right? Certain assets tend to underperform in certain periods. You fail to understand certain risk in terms of things that can suddenly come your way, uncertainties that can come. These are things that people kind of miss, and that's about 65% of the retirees who face this. And the other component is underestimating the life expectancy, right? So compared to before, people live for more longer, and you fail to realize that your life after retirement can be almost about quarter of your entire life, or almost 20 to 30 years of your life. And from the final point is that even though you plan for retirement, there is a possibility that due to job insecurity, the possibility of losing your job, you might not be fulfilling the time until retirement, right? So these are the common retirement issues that people face on a common basis. So this is an interesting chart, right? So from 1960 to now, if you look at Sri Lanka's life expectancy, Sri Lanka's life expectancy has increased substantially, right? Our overall average life expectancy is now close to about 82 years, and that is just the average figure, of which female have a slightly higher life expectancy, whereas male have slightly less. So even if you retire at 60 years, you have easily on average roughly about 22 to 23 years. And this means that there is a possibility it could be 30 to 35 years as well, right? Are we ideally planned for such a longer retirement? And our financial resources accumulated enough to cover for a retirement as such. The second reason why you really have to focus on enough resources to compensate for retirement is because the unexpected economic shocks, like what Sri Lanka faced in 2022, which can completely derail your investment journey and the lifestyle that you live post-retirement, right? For example, in 2022, if you had 10 million rupees in terms of investments, the average returns were around 12% per year, which would have given you about 100,000 per month. And at that year, the inflation basket was roughly about 92,000 a month, right? So you're comfortably managing your expenses with 100,000 income that you're making. Come 2025, this has completely changed. If you have 10 million rupees right now, returns have fallen, your bank returns are less than 8, and you're taxed even higher, which means that even on a best case 8% return, you're only making 66,000 rupees a month, right? And the CCPI inflation basket today is almost crossing 190,000 rupees in terms of a figure, right? So you're not able to compensate with the ideal amount of investment that you thought would be ideal back in 2022, which is why you need to kind of think of emergency planning. How do you kind of hedge for inflation? What are the assets that you can invest in? And so forth. You need to kind of plan for those as well. And also the most critical thing, I would think from a Sri Lankan perspective, is that the government's spending on healthcare has been reducing over time, right? This graph shows how much the private sector or individuals like us, what percentage of the total healthcare expenditure is spent by the private sector versus the total healthcare expenditure, which includes the government component, right? So at present, 57% of the healthcare expenditure is borne by the private sector, which is by people like you and me. And the amount that is borne by the government has reduced to about now 43%, compared to about 50%, which was there a decade ago, right? So you see this number coming down where the government is unable to keep up with the escalating healthcare costs. The service levels are deteriorating. There's a shortage of doctors. So these all kind of moving towards the private sector hospitals, right? And that means that you have a higher expense that you're incurring from a healthcare perspective, right? And for example, if you have a heart surgery or so, there's a 90% chance that it might take even 5 to 6 months for you to get an appointment or to get a surgery done at a government hospital. And the average waiting time reported for elective operations at government hospitals is at 9.4 months, right? So you can see the waiting list increasing over time. It was 6 months a couple of months ago. Now it's about 9 months. And this means that as individuals, our reliance on government healthcare is reducing over time, right? And we have to bear that cost in terms of what we need to spend on healthcare as individuals. So to summarize, the 5 key risks, right, that you kind of encountered in retirement is A, not saving too much or withdrawing too soon. Second, not planning for inflation and letting inflation eat away your savings power, purchasing power. Not planning that longevity of your retirement for the full length of your retirement. Not take into account the medical costs, and not allocating your assets at the appropriate asset classes to weather changes that are happening in markets in terms of risk profiles that are changing on a day-to-day basis, right? So these are the things that as individuals we need to plan for our retirement and keep in mind that these are risks that we can face. So take a minute and think about these critical questions. Do you have answers to these questions that we're talking about, right? And these form the ultimate playbook into what you need to do and how you build a solid retirement plan, right? So let's start from a spending goal perspective, right? Do you have an idea in terms of what kind of age that you plan to retire? Is it 60? Do you want to retire earlier? Or do you want to keep on working even after your retirement period, right? Have you imagined how will your ideal retirement life look like? Are you going to be traveling? Are you planning to migrate? Or are you comfortable enough to downsize your lifestyle and live a more you want to live, right? So picture how your retirement will look like. And based on that, your spending patterns and what you need to kind of build will differ. Third question is, how long do you need your money to last? Does it need to be for 25 years, 30 years? And critically, do you want to leave behind a legacy or inheritance for your next generation? And if so, how much do you want to leave behind for your next generation? And the final question I'm sending is that how much of your current spending right now do you think that you will need during retirement, right? The usual benchmark is that if you don't have expenses like traveling or lifestyle, usually your retirement expenses about 70 to 80% of your current income levels on present value terms, on today's terms. So to achieve that, what do you need to have to achieve these goals, right? Be able to pass on your generational wealth, to have a comfortable retirement until 90 years. What is the kind of pool that you need to have? Also, the other critical question, how many of us, if I ask that question today, have an indication of how much assets that you have in total as of today, right? Whether it being the bank account, whether it being your stock portfolio, whether it being the EPF balance in your account, how much gratuity you've accumulated up to now. Do you have an idea of how much assets that you have? And in case of a critical scenario, how much are you leaving behind for your next generation if something happens to you today? And how much loans do you have that you need to settle in case of something happens? And also, do you have a life insurance policy, right? The criticality of life is increases if you don't have enough savings when you're starting your career, right? The more and more that you accumulate wealth, the need for life insurance kind of goes down because your assets can compensate for any health or critical illnesses that come over time. Have you thought about when you will be taking out your EPF, ETF? EPF is normally at 60 years old. ETF, there's a chance that you can take it beforehand. When are you going to materialize your gratuity? If you're working in an organization for more than 5 years, when are these going to materialize? And what are the reliable and guaranteed income that you will have in a post-retirement phase, right? We have your savings income. We look at a few things which will kind of income sources for you. But have you thought about what you will use to live in a post-retirement phase? And finally, how much capital do you think that you need to accumulate to fulfill the dream requirement that you're looking at? From a risk perspective, planning for retirement is easy, or you can plan for it, but there are unexpected things that can happen. For example, you might have to retire before the age of 60 or 65. There's a probability that you can lose your job. And if that happens, how are you going to manage your healthcare bill? Right? Do you have a health insurance? Do you have life insurance? How are you going to manage that? Right? How will you fund potential long needs that are not covered by insurance? And how much of emergency fund have you set aside in case there is a market downturn, inflation increases? What is that pot of assets that you have to mitigate during a crisis? Right? So these are the critical questions that needs to be in your mind when you're thinking about retirement. Right? So we'll answer some of these questions a little bit more detail in the next section, but I wanted to put up the thought process for people to think about what are the critical things that we need to be thinking right now, because as individuals, we always think about today and tomorrow, whereas not thinking about 20 years later. And finally, from a retirement planning perspective, have you looked at how are you going to pass on your wealth and legacy to your next generation? And do you have all the updated legal documents done, which is necessary for a smoother transition of wealth over time? So these are the critical questions that you need to kind of look through when you're planning for retirement. So let's look at what are your potential sources of retirement income. Right? What can give you that pool? Obviously, the money that you've saved up to now, right, is a pool that you will always have. But in addition to that, keep in mind there are some lump sum payments that you need to be mindful of. When you retire, you get your EPF contribution, your ETF contribution, which probably you might be able to withdraw ahead of time. Gratuity. If you've been working in an organization for more than 5 years, you're entitled for gratuity. If you have a life insurance policy and that's maturing to, say, let's say age of 60 or so, you get the maturity proceeds as well. And are there assets that your parents or going to pass on to you? Right? So these are things that can come as positive inflows to your current savings that you have right now. Also keep in mind that the balances that you have here are not necessarily the final income that you get, right? Because there are tax implications that you will also face. For example, if gratuity is less than 10 million rupees, your tax rate is 0, 10 to 20 million is at 6%, and anything above 20 million rupees is at 12%, right? So your lump sum payments are also subject to certain level of taxation, right? So we need to look at things on an after-tax perspective, right? So using this pool of funds, the potential income that you will generate on a post-retirement phase is if you have a pension running, or if you're a government employee, you'll have a component of pensions running. If you're part of a private pension plan, you'll have that coming in. Second is, on the cash that you've accumulated up to now, you will be making a return on investment. So that's a large component of your source of income during retirement. This, on the above sources that we saw, on the lump sum payments, you can also make a return. And sometimes you might also be doing a part-time employment after retirement, which can also add to your potential retirement cash flows, right? So these are the sources that you will accumulate over time and just before retirement. So using these resources or sources, you need to see whether that can comfortably cover your retirement goal. Something happened. Just give us a second. There's small technical. Sorry about that. And also you need to be planning for certain certainties and uncertainties that can happen in the future, right? The ones you have to plan for, obviously, are things like child's education, particularly if you're looking at sending your child overseas, which can be quite costly in this day and age, right? For example, if you're sending it to a country like UK, Australia, and so on, your costs could be crossing now 30 to 40 million rupees in terms of the expenditure that you pay for your kids' higher education. Your kids' marriage that you might have to finance. If you're going to buy a house over time, that will also be an expense that you have unplanned for. And in current day and age, owning a vehicle, and if you're upgrading a vehicle, that also becomes a critical decision given the context of the larger investment outlay that you need to kind of make right now. But there are also uncertainties, right? Like what I said before, we need to plan for sudden hospitalizations that can happen, natural disasters which can kind of wipe away our income, job losses that can happen, and also potentially the need to migrate if there are issues and so on that can happen in the future, right? So these are additional things that you might have to plan for and keep an emergency fund, right? So the uncertainties are which you need to keep an emergency fund for, and we'll talk about in the next couple of slides in terms of how you can maintain an emergency fund. So part of your wealth has to be in liquid assets, which can take it out at any time and utilize for uncertain emergencies that can happen in the future. For the certain things, certain elements like the ones on top, which you know or which will happen, you can plan ahead, right? If your kid is now 5 years and is going to higher education towards 18 years, you have a 13-year period to plan for that, right? So you can look at long-term investments which can help your kid to achieve that goal, right? So like that, for the certain areas, you can plan ahead of time. And the most common mistake is people underestimate how much they would need at retirement. So think about it, right? So I'll just give us a quick example here. Just think about how much you would need to have if this was your requirement, right? Let's say, for example, you need 150,000 a month, which is equivalent today, in today's terms, in 20 years' time, right? So it can increase based on inflation and so on. But to live a comfortable life, you feel that 150,000 rupees today is good enough as my living expenses. Just an example, right? If inflation was 6% and the returns that you're making on an after-tax basis was 8%, how much monthly do you need to contribute now to achieve that 150,000 equivalent return in 20 years' time, right? And this is without affecting the principal that you're accumulating in 20 years' time. Just if you're assuming that you're going to live with your return that you're making on the investment portfolio, right? So to summarize, if you're going to live a life which is your expenditure is going to be 150,000 a month, equivalent of today, in 20 years' time, with an inflation of 6% and a return of 8%, how much do you think you need to save today to achieve that 150,000 goal in 20 years' time? Just think about numbers, right? So first, to derive what you need, right? First figure out what your future monthly savings will be or spending will be, right? So to calculate your future monthly spending, you look at your current spending, which you think is 150,000, grow that by inflation, over the number of years of retirement, right? So in our case, this will be 150,000 into 6% inflation to the power 20 years. And the compounding effect will mean that you need to have 481,000 rupees a month to cover for your expenses 20 years down the line, right? So that's the monthly expenditure need in 20 years time. Second, if you need 481,000, how much of assets or how much of lump sum money that you need to have? So to calculate this, what we do is we take the 481,000, which is the future value of the monthly spending. That's for a month. So we multiply it by 12, and that has to contribute in terms of return. So we divide it by the investment return, right? So 8% has to give you that 481,000 rupees, which means that you need to have 72 million rupees in your account in 20 years time to hit that 150,000 goal in 20 years time, right? So it's a fairly large chunk of money when you look at it that way. And if you translate this into today's terms, if you start today, how much you need to save now, we can do an annuity calculation where you take the lump sum payments, take the monthly return. So if it's 8% annual return, you divide it by 12 and take the number of months retirement. If it's 20 years, it's going to be 240 months. You work out the calculation and you need to be saving 121,000 rupees right now if you are to 150,000 equivalent retirement spending in 20 years time, right? It's a fairly substantial amount when you look at it that way, right? So this is assuming that you're not going to use the capital that you will accumulate in the future, but assuming that you're going to use the returns to finance your in 20 years time, right? So which is why it's a substantial amount, right? And you need to start saving now to get to this point in 20 years time. And in this entire equation, the interest rate or the return that you make plays a critical role. So if the return accumulated, we assumed in our previous scenario that it was 8%. But if you keep your money in a savings account, for example, running at 3%, that means on a monthly basis, you need to be pumping in 219,000 rupees to your bank account to get to that 150,000 equivalent retirement spending. And if you look at the different, as your returns increase, because of the compounding increase, the amount of investment or the monthly saving that you need to do right now reduces, right? Which is why where you invest and achieving a decent return matters a lot to this equation, right? So for example, if you are investing at 11% return right now, that will mean that you only need 82,000 rupees, need to be saving 82,000 rupees right now to achieve that 150,000 spending goal, right? Compared to 219,000 that you will have to save right now if your money is simply sitting in a savings account, right? So we need to focus on maximizing the investment return. And keep in mind, if you have a longer term investment, there is no point keeping your money, particularly the money that you are putting away for retirement, doesn't necessarily have to be in a 1-year deposit or a savings deposit, because this is money that you're not going to touch and you're going to invest for the long term. Yes, keep part of your portfolio in an emergency fund where you can liquidate at any point, but you would mindfully have a component where you will feel that component can be allocated for the future and that component can be parked for the long term. And long term means that you can achieve a higher rate compared to the short term returns right now. This equation in a different way, if we slightly look at a different scenario, let's say, for example, the same scenario, but let's say that you've accumulated about 5 million rupees already. You have a savings portion of about 5 million sitting in your accounts right now, right? And let's look at if your inflation is 6%, your after-tax return is 8%, how much you still need to contribute, provided that you have already accumulated 5 million. I'm just giving examples so that you can think about what is the kind of cash pool that you need to kind of build over time and what is the savings that you kind of need to be allocating out of your salary or income that you're making right now to achieve the objective of your ultimate. So it works in a similar way where we first calculate what our monthly spending will be 20 years down the line. And that will be like what we did before, 481,000 rupees. And the lump sum payment also won't change, which will be the 72 million rupees that we looked at. But we can also minus the lump sum required by the future value of the current savings that we have, right? So if you have 5 million rupees right now, if you have 5 million rupees right now, and that's running at 8%, let's assume that it runs at 8%, that 5 million rupees will be 23 million rupees in 20 years' time, right? So technically, you need 72 million. Your cash that you have will make you 23 million. So the gap that you need to finance is the 49 million rupees over the course of the 20 years using your monthly savings. So if you work that amount out, you take the 72 million minus the 23 million and work the annuity factor computation, the amount that you need to save per month, assuming 8% return, will still be about 82,000 rupees a month, right? Now, this is under the assumption that the capital that you accumulate is not used in the future, but is passed on to the generation. But you as a retiree are using your returns to fund your expenses, right? Still, you see that compared to average Sri Lankan income, which is about 200,000 rupees, I would say, if you're in a slightly middle to high income kind of category, it's a fairly lot of income that has to be saved on a monthly basis. So we now have a method to look at the madness in terms of how much we need to save, right? There are multiple ways that you can look at this equation. What we have not factored in is the lump sum payments that can come in the future in terms of EPF, ETF payments. Those also need to be put in the equation in terms of calculating the future value of what they will be and minusing it out of the lump sum requirement and doing the same calculation again. There can be also a scenario where you don't want to deteriorate your wealth and allow it to grow in line with inflation, which means that you might have to allocate even more right now. Sometimes you might think, okay, I'm not going to give my entire wealth to my kids. I'm going to use 50% of what I'm accumulated for myself. Then your requirement might sometimes be lower. So these are combinations and permutations you can modify in this equation to get the desired level of retirement saving that you need to do right now, right? So I've given a couple of examples here to create that thinking process so that all of you have a starting to think about how much you need to start saving right now. Now, once you figured out how much you need to kind of save, then the decision comes in terms of where do you allocate your assets. So before we go into figuring out what assets to invest and so on, the big question that runs in a lot of people's head is, we are talking about long-term 20 years. Will Sri Lanka be stable for the next 20 years, right? Will we go through another crisis which can affect our returns and the purchasing power that we have right now? The good news is the current trajectory says otherwise, right? So I think a lot of people have concerns around Sri Lanka facing another economic crisis and so on. But at the moment, looking at current trajectory, Sri Lanka is on a phase where we are becoming more sustainable in terms of debt, and into some of the key the policy measures that we've done and the changes to our fiscal policy, where Sri Lanka is not printing any more money, where government is making revenue higher than its operating expenses. Central bank is independent, where they're making decisions on monetary policy, targeting the inflation. The central bank is accumulating reserves to manage the increase in terms of the debt burden that will start increasing from 2028. And the state-owned enterprises are pricing in their products, example, electricity, fuel, at reflecting the cost that they're actually reflecting, right? So these now led to Sri Lanka's debt to GDP on a downward trajectory. So the IMF target is about 95% debt to GDP by 2032. At current trajectory, Sri Lanka will be at about 88% debt to GDP by 2032, right? If we continue with these current policies, not changing much, not easing anything fiscally, Sri Lanka will be comfortably able to manage its debt burden, as well as what you call as gross financing needs, which is managing your annual debt repayments and the fiscal with the amount of income that you have, right? So the IMF requirement is that number should be less than 13% between 2027 and 32. Sri Lanka, at the moment, based on projections on how taxes are being collected, this number will be less than 12% looking at the next 5 years, right? This all means that current trajectory, assuming governments don't change policy, if we maintain the current trajectory, Sri Lanka will comfortably pass that 2028 milestone in terms of debt repayments and so on, right? So now it gives us some leeway to comfortably take long-term positions, to make those investment asset allocation, which were hesitating in the past to make, right? And the other critical thing is that Sri Lankans typically, out of their total deposits, almost 30% of their money sits in a savings deposit, right? So this graph here shows if you had 1 million sitting today, if you had 1 million rupees with you, and if it was at different asset classes, right? How much will that 1 million be using if you had invest in a fixed deposit, if you had money in a unit trust, or just the purchasing power adjustment for inflation, right? So now you look at if inflation keeps running at 5%, your value of 1 million, the 1 million will increase to 1.5 million because your purchasing power reduces. And you can see that the savings deposit is not going to make kind of money and is not going to compensate for inflation. And you can see the gap between the alternative asset classes, what the difference between the blue line and, for example, the yellow line will be. Because of the compounding impact, this gap will be substantially significant, which people fail to materialize. And why Sri Lankans, it's very difficult to understand why Sri Lankans still have almost 30% of their deposits, even when interest rates were high at 20-30%, keeping their money in a savings deposit, which is not compensating for inflation or covering up for the purchasing power, right? So the target should be to beat inflation. And we see inflation being in the 4 to 5% mark in the next 5 to 10 years or even 20 years, if the current trajectory continues, which means that if you can comfortably beat inflation by about 3% on an after-tax perspective, you can comfortably work towards getting to your retirement goals, right? Now, 8% return on an after-tax basis means that now you might have to look at a gross return of about 12 to 13% as well, right? And that's because of your higher income thresholds being taxed at 36%. And keep in mind, even during retirement, under the current tax regime, even on interest income, if it's crossing 300,000 rupees, you will be paying 36% incremental tax on your interest income, right? So you need to start looking at after-tax income, factoring in if you're crossing that 300,000 threshold, factoring that 36% and figuring out what is your gross return or your net return compensating for the impact of inflation, right? So you need to make more than the 5% or 4% inflation on a net return basis using the funds that you have. And it's still possible. Now, looking at a scenario, now I spoke about future, if you start today and where it will be, but let's take a look at how your portfolio would have been if you had invested in 5 different asset classes 20 years ago, right? So if you had invested in 2005, and these are actual numbers that I've computed based on market performance and rolling over of debt instruments, this is how your portfolio would have been, right? So if you look at the average inflation between 2005 to 2025, the average inflation was about 8.5% per year, right? Interestingly, and this also came shocking to me, the share market has yielded the highest return in terms of 14% return. This is factoring the dividend yield of the market as well, right? Treasury bonds have come second, bills third, bank deposits at 10.9%, and bank savings deposit at 3.2%, right? So you can see that the long-term products kind of outperform in the long run, right? Which is why, particularly if you're looking at retirement savings, looking at a longer term horizon, look at asset classes that will give you returns above the benchmark on a long-term basis, which can be your equity market, even though there are short-term market ups and downs, on a long-term basis, it looks like the share market is the place where it kind of outperforms the rest of the asset classes. And this is not only the case for Sri Lanka, it's the same in the US, it's in the markets where the share market gives a above average return, right? Similarly, long-term products like treasury bonds or debentures will give you a higher return. And particularly if you don't have the need to lock in your money, or don't have the need to spend the money right now and can afford to lock in your money, longer-term instruments will give you a higher return. And also keep in mind the current yield curve of Sri Lanka is where the long-term yields are slightly steeper than the short-term yields, right? So normally back in the day, the gap between a 5-year bond and a 10-year bond was almost about less than 1%. Now we see the 5-year bond is only about 9.3, 9.4%, whereas, for example, the 10-year bond might be about 10.75, right? So there's quite a bit of spread in terms of almost about 140 basis points or 1.4% if you are going or can afford to fix for a longer period of time, right? So if you have a component that you can lock in comfortably for the long term, Don't keep money in short-term or one-year instruments. Go for long-term instruments, comfortably locking them so that you make that above average yields and benefit from the impact of compounding. So the other question we get quite often is, how do we decide between how much to allocate between equity and fixed income based on your age, right? So if you're in your early part of the 20s or younger in terms of your age profile, we recommend, and it's the standard, that we allocate a larger component to equities. And over time, as you age, your allocation towards equities reduces over time. The standard global equation that they use, a benchmark, it's not a given rule as such, but a benchmark that they use is your equity allocation being 100 minus your age. For example, if your age is 20, you allocate minus 20 or 80% in the equity component, whereas 20% is allocated to fixed income, right? Now, I would say that given that Sri Lanka having relatively higher rates, interest rates, we can treat this equation to say 90 minus age for equity and fixed income allocation, right? For example, if you're 70 years in terms of age, your will be 90 minus 70, which is 20% to equities and 80% to fixed income instruments. So as you age, you're targeting more stable fixed income, because you don't have any other sources to kind of compensate you in case there are uncertainties and things that you are not be able to predict. From a saving perspective, break down your investment goals into your working phase and your retirement phase. In your working phase, which is up to 60 years in Sri Lanka's case normally, you look at adding to your pool of investments, which is contributing, like saving to your cash, focusing on asset growth, looking at how you can grow the assets above the benchmark returns, right? Which is why I said, look at equities, look at long-term products, and you have the opportunity to kind of that cushion to invest for the long term. But once you cross 60, the way that you look at it will be different, right? Because you're not going to be saving, you're going to be withdrawing, right? From the age of 60, if you're retiring, you'll be withdrawing from the pool of funds. You'll be net cash drawing down. And also you have to focus on return certainty, because you don't have the option of being able to protect yourself against volatility, because you don't have assets that you can add to your equation, right? And also when you're in retirement phase, you look at short-term investment products rather than long-term investment products, given that your longevity is less at the point of retirement, right? So your investment profile changes based on whether you're in retirement phase or the working phase, right? And it's not a straight line curve. It's a gradually reducing curve where you focus growth at the beginning of the cycle and looking at return certainty towards the part of the retirement, right? So this is a breakdown of how you can look at your spending and asset allocation if you're in your retirement phase, right? This is after, let's say 5 years, right? You can break down your spending into 3 components. One is your stable spending, which is your day-to-day expenses, managing your grocery bills. That's your stable spending. Let's say, for example, that's 50,000 rupees of your monthly bill. You have your variable bill. This can be how much you're spending on travel, gifting certain things, buying a car, for example, things like that, which are variable in terms of nature, right? And then you have your legacy component, which is the assets that you're passing on to your next generation, right? So you can split your expenditure into these 3 buckets, right? You need to match your stable income. For example, the protected lifetime savings which are going to come, the money that you're going to generate from your fixed income portfolio, the pension that you're going to get, the EPF returns, that should be matched to your stable spending, because you can't not be able to cover to not compensate for your stable spending. So for example, if your stable income sources like the return on your fixed income portfolio, pensions and so on, 60,000 rupees, you match that 60,000 rupees against, or putting a benchmark of saying, I'm going to spend only 60,000 rupees on my stable spending. The amount I make from diversifying my assets, which can be in the form of going a little bit towards dividend income sources, fixed income portfolios with a little bit of corporate debt exposure, having a bit of equity allocation, real estate allocation. So this is a component that in case something happens to you, you can comfortably kind of cut down if required. You cannot stop traveling and so on. But this component can be financed by that relatively higher risk component, risky assets, right? And also there's a component of cash and cash equivalents that you have, which is meant as a cash buffer that you keep for emergency purposes. And the other component, which is legacy, passing on to your generation, is even if in your 60, if you want to keep accumulating wealth for your next generation, you can allocate certain component of your portfolio towards growth portfolio, towards equity, towards assets which can generate an above average return. But it's a component that you're going to take a higher risk, and there's a possibility that your returns can accumulate or decelerate over time, right? But you can afford to do that because you're not saving it for you, not your longevity, but for your next generation's longevity, which you can invest in a longer horizon, looking at growth assets for your legacy component of your portfolio. So think about if your expenses as what do I make on a stable basis and matching against your stable spending, which your day-to-day spending, match your more income sources in terms of dividend portfolios, corporate debt, all that covering your variable spending, which is things like travel and so on, which is discretionary in nature, and taking a more risky component if you want to accumulate more wealth for your next generation. So few things that you can also keep in mind when you're considering asset allocation. A, opt for longer term duration. If you're targeting retirement in particular, if your funds are focused towards retirement, always have an emergency liquid fund. And how I would recommend you to look at emergency fund is keep part of your component in a fixed income unit trust, whether being a money market fund or income fund, without keeping your money in a savings account, because it still will make an above average return. For example, the CAL fund makes about, the fixed income opportunities fund makes about 9.5% after net, which is still like a savings account where you can withdraw money whenever you want, compared to a savings deposit, which only will make about 3% in terms of return. And in early part of your life, you allocate large part of your equity portfolio towards growth stocks, companies which will grow in nature. And towards your retirement phase, you look at defensive stock. And I'll explain that in the next couple of slides in terms of what your stock allocation can be. Also, real estate, real assets tend to kind of give you a hedge in terms of inflation and so on. So particularly if you're anticipating crisis and so on, move your assets towards part of the assets component, which can be whether it being a real estate, commodities like gold, or inflation-linked bonds, right? But this is a call in terms of what your inflation number will be or inflation target will be. At the moment, our preference is to keep a lower allocation, given that the inflation forecasts have come off compared to the 8.5% inflation that I was talking before. Now the inflation that we are projecting has reduced to about 3.5% to 5% in nature. And don't keep all your assets in one place. Diversify as much as possible and ensure that two assets are not correlated in nature, right? So for example, if you just have, say, treasury bonds and equities, both benefit during times when interest rates come down, right? But when interest rates go up, both asset classes kind of underperform, right? So you need to have other asset classes which will kind of when times are difficult and times change. Also, if you have dollar earnings and so on, ensure that your earnings are accumulated across not only in Sri Lanka but also outside the country, and that's only possible because if you are a dollar income earner, because Sri Lankans are, if you're a rupee earner, you don't have the ability of taking the money outside. And always look at after tax returns. Financial institutions posting their returns on gross basis, but what you see is on an after tax basis, factoring the 36% on a higher level for income. What is my after tax return compensating for my inflation level? So this is a picture of what kind of long-term investment asset classes are there right now, and what are the return profiles right now if you're looking at investing right now. These are just an example. I've just taken current returns of certain products that are available in the market. As you know, 1 year deposits before taxes are making about 8%. A 5-year bond is about 9.3 to 9.5. A 10-year bond is at about a closed-end fixed income fund, like for example, the one that Cal launched the previous month, gives about 11% return with a tenor of about 3 to 5 years. If you're investing in debentures, particularly investment grade, you're still able to get about 11.5% return on good quality corporate debentures. So still you can make about, if you want to, 3 to 3.5% above what you're making on the bank deposit. And this is money that you can put away for the long run if you have a component that you don't want to touch for the moment, right? And if you're looking at an equity portfolio closer to retirement, these are the characteristics that you need to look at from an equity stock perspective in terms of the stocks that you kind of pick, right? Because you want to take that volatility in markets and uncertain behavior of markets, you need to look at more stable income sources. So you look at companies which are less in terms of beta, where the company's price movement is slightly lower than what the market is moving. You look at utility companies, banks, conglomerates, which move slightly lower than what the market is moving. The good thing is that the volatility in those returns will be less, which kind of protects you against any uncertain movements in markets or potential market downturns that you might see. Look at companies which will have a predictable cash flow, right? So these can be consumer companies, FMCG companies, which have a more stable kind of income on a continuous basis, right? Look at companies, blue chip companies, which have exposure to FMCG and so on, which can kind of have that predictable, strong cash flow. Compared to investing in sectors like plantations and so on, which is not ideal in a retirement phase because of the volatility of earnings. You're better off taking that exposure at a younger part of your career rather than taking exposure to volatile sectors like plantations, like, say, mining, things like that, that will be more volatile and can have sudden dips in terms of your portfolio performance. You look at defensive blue chips, you look at companies which give you a higher dividend yield. Still, we have utility companies and so on, which in Sri Lanka give close to about 7 to 9% yield on a dividend basis, which are good for the long term. There is a capital appreciation potential, but also the dividend acts as a cushion and is an annual income that you can make. So focus on companies like that when you are looking at retirement. And look at companies which have a low debt to equity ratio, which means that they won't be susceptible to shocks in terms of economy and interest rates changing. They will be less impacted by those. So these are characteristics of shares that you can look at from a retirement perspective, right? If you're closer to retirement or at retirement, you can look at this kind of stocks. Also, as I mentioned, tax planning is a critical part of the equation, which means that now you need to start looking at after-tax returns. So what are the possible tax-efficient products available in the market right now? So one is equities, obviously, because the capital gains tax, the equities are, or public equities or shares are exempted from capital gains tax. Even on dividends, dividends are only taxed at 14%, compared to interest income, which is taxed at 36% if you're on the high end of the bracket. Unit trust funds give you that benefit of postponing your tax payments, right? If you don't withdraw your money and you keep accumulating the money in your unit trust, you just need to pay the taxes at the point of withdrawal. And in a scenario where we're looking at Sri Lanka probably going to reduce income tax rates over time, if you withdraw the money when the tax rate is reduced, you have to only pay that tax that is applicable at that time for the entire money that you accumulated over time, right? And that is a very high probability that we see that given the higher tax collection that the government is achieving right now, there's a very high likely chance within the next 5 years, you might see the overall tax rate on income being reduced over time from a above average level that it's being right there right now. The other investment that you can look at, particularly if you're someone who's traveling quite abroad constantly, every time you go abroad, you can save about 5,000 rupees. You can buy from the market, from the banks, and can be, when you're coming back, you can invest this in financial institutions. And typically they give you about 4 to 5.5% in terms of deposit returns. So you have the ability, and these are tax-free instruments which you can invest. Also, you can protect against depreciation of the rupee, which will mean that you still can make 10-11% on a dollar basis after tax, from an after-tax perspective. Also, there are some structured financial products that can benefit in terms of postponing the tax payment towards a future period of time and benefiting from the compounding effect by not paying that tax in the period, right? So these are typical products that we can look. Structured products are what investment banks like us kind of to encourage people like that to invest for the long term without getting a higher tax burden as such. So the final part of the equation is, if you're passing on wealth to your next generation, what are the key things that you need to kind of keep? One thing that you can immediately start doing is having nominee accounts, nominees for your bank accounts or even your unit trust. You can have nominees being allocated for, right? So whether it being your kid or anyone, you can you can put them as nominees, fill in the nominee form. Even for unit trust, you can do this, where in case something happens, you don't have to go through a testamentary case. And if you have signed the nominee, the money gets transferred to the nominee. And it's good practice that you have a last will, so that there is no confusion when it comes to distribution of assets. If something happens to you, and the next generation, the pool of assets at the particularly planned manner that you've looked at. And a last will doesn't mean that you have to write something today. You can at any given time the will that you're writing in the future, right? So what you've written yesterday is not valid if there is a change in terms of, if you want to make a change in terms of the will. The good thing is that it helps smooth the transition of wealth. Yes, it has to go to a testamentary case, but usually through a will rather than being on a pure testamentary case, or if it goes through probation as such. And also, inherent tax is tax efficient when it comes to Sri Lanka, because you get taxed when you're passing on your wealth to a next generation, compared to gifting someone. When you're gifting in, there is a likelihood that you might be subject to capital gains tax, right? So passing on your assets through a will is positive in terms of tax as well, because inheritance will not be taxed upon passing on to your next generation. And for more complex, large portfolios, you can create trust structures where taxation is efficient, and also the transition of assets is more efficient, and you don't have to go through a testamentary procedure to pass on your assets, because the trust automatically, through its legal proceedings, will automatically pass on the assets to the next generation or so. And you can create charity, things like that, through the family trust setup as well. You need to have your power of attorney given to someone or your close relatives or your kids. If in case something happens to you, they can sign on behalf and transfer the assets. And finally, always keep running a consolidated asset register. At any given time, know how much you have, list down all assets that you have, whether it be in deposits, your EPF balance, the loans that you have given to, have a register. So in case something happens to you, the next generation is able to take a quick look at what you have, and it's an easy process of transition when it comes to generation wealth transfer. Finally, as Cal, what can we offer you in terms of a retirement product? Obviously, if you're a larger investment portfolio, we can customize a portfolio that will bring in those structured financial products, which will give you a higher return, will make you comfortable in terms of retirement, and also make it more tax efficient in terms of planning for a retirement with a higher yield adjusted or risk adjusted yield basis. We also provide long-term investment products like debentures, closed-end funds, which typically can go up to about 3 to 10 years, floating rate bonds, which adjust, for example, in line with inflation, with interest rates. We can protect against market movements in a long term. We also offer structured investment products like zero coupon bonds, capital protected loans, which to a certain extent are tax efficient and also ensure that your capital is protected over time. We offer unit trust products like the fixed income funds that I spoke about, equity and balance funds. If you particularly don't have exposure or don't have enough knowledge about investing in the share market, take exposure through the unit trust funds, which will automatically do the asset allocation that is needed, right? But from a retirement perspective, the unit trusts help in a way where if you don't touch the money, you can postpone the tax payment. Also, you can sub-accounts where you can create a retirement component and a emergency plan component. And if you have monthly expenses, you use the emergency plan component and not the retirement plan component, because the retirement component can be used for the future and withdrawn at the point of retirement or from a longer term perspective without paying that on withdrawal right now. So it's better if you are looking at retirement and emergency funding separately, keep two sub-accounts for that particular purpose. And also from a listed share perspective, we also trade securities in the market. So we give advice in terms of investing in the share market as well. So these are the typical product portfolios that we as Cal can help you with from a retirement perspective. And that sums up our presentation for today. If you have any questions, feel free to kind of drop your questions on the message and we will answer it for you. And also, if you log into our website, there is also a small retirement calculator you can use to calculate what your potential savings cap is to be and how much you need to save can be looked at or worked on a very simple basis, right? So is not something simple. It's something that you need to plan for today to achieve that goal 20 years or 15 years down the line. And without careful planning, it becomes a problem in your long term. So on that note, I'll be happy to take a few questions that if you have any questions for us. So I think there's a question in terms of investment options in Sri Lanka, relatively low compared to a lot of the developed markets. When do you think we might have, or CAL might launch index-linked funds linked to ASPI, S&P, or gold investment funds or commodities? We are in the process of creating of them. Hopefully, within the next 12 months, we might have a couple of the index-linked funds running from the investments, CAL investments perspective. So work in progress. We are almost gearing towards it and have started the process on it already. Also, there's a question on REITs and whether we'll be looking at real estate investment trusts and so on. Unfortunately, we've been trying a lot to get into this area because it's as a potential opportunity out there to capitalize on this. But unfortunately, the tax system in Sri Lanka doesn't help the cause, which kind of makes you pay a higher taxation rate for real estate asset when you put it into a trust, which makes it impossible to make a return. So it's an issue with the taxation structure, which makes it impossible for us to give a higher above average return on the equity portfolio. Can we open a foreign currency deposit account in Sri Lanka? Can we open account via CAL? No, we can introduce you to banks. Banks can do this for you. Every time you go abroad and so on, when you bring those dollars back, you can open an NRFC account and place those deposits in that account. Only thing is that when you're withdrawing it back, you can't get it back in dollars. You can pay for dollar expenses or take it for future dollar expenses, but they can hit you. But it makes that dollar return over time. So what is the difference between fixed deposit and a fixed income opportunities fund? Does it have to fix for some particular period of time? No, you don't have to fix your investment for a particular period of time. It is money that you can withdraw at any time. Just that it gives you a higher return compared to a typical FD, and it's tax efficient in nature because the rates that we quote today, which is about 9.5 net, is after taking into account the withholding tax of 10%, whereas financial institutions report it before the 10% tax, right? And the benefit is also on diversification, where it invests in large number of investment fixed income products. So you're automatically getting the benefit of diversification to it as well. A few more questions coming our way. I think, how can Sri Lankan expats living abroad invest? There is a account that you need to open through the bank, which is almost called like an IIA account, through which you can still invest in unit trusts and so on. Even equities, all that, you have to come through that account. It's a little bit cumbersome compared to just directly investing using a NIC in Sri Lanka, because the process takes a little bit more documentation compared to the others. But it's still possible to invest using, if you have the documentation, you can still take exposure to Sri Lanka, fixed income and equity investments. Real estate, on the other hand, what are your thoughts on real estate investments? It is also an attractive asset class. We've seen a growth in real estate in the last 12 months, particularly Sri Lanka after coming from a crisis. We've seen the inflation adjustment trickling down to real estate as well. So that's an asset class interesting, but we'd be particularly selective in terms of which real estate asset types that we invest. We'd prefer commercial, tourism-related assets, which give you still a 8-9% dollar return compared to things like apartments and properties in Colombo, which only give you a 2-3% rental yield and the capital appreciation is limited. Is there a way out to invest in foreign equity markets from Sri Lanka? To be honest, at the moment, the regulations of central bank don't allow Sri Lankans taken money abroad. But if you have money abroad, we can obviously help you, particularly if we have in Bangladesh, we have frontier market funds, which we can help you invest. There's a question on vehicle prices appreciating, and how do you think vehicle market investment is an opportunity? To be honest, we don't see it as a growing asset class like what it was in the past. And the reason being that tax structures are very high right now. The possibility is only that over time tax rates can come off, not increase from here. And as a result, we don't see continuous appreciation of vehicle prices like what we've seen in the last 10 to 20 years. So there's a question in terms of what are the kind of fixed income opportunity returns that we are seeing on our unit trust fund right now and what our expectations are. The current run rate is at about 9.5 to 10% right now. And we feel that trade, given the current interest rate climate, we can maintain for the long run as well. How should we time the investment in equity fund? Should we invest when the ASPI is down to get a good return? Or is ASPI not something we need to worry about? Does the fund manager make sure we get the best returns regardless of when we invest? So to be honest, the fund tries to do is to pick shares which will outperform the market. But keep in mind, when there is a significant downturn, even the good shares can typically go through adjustment. What you need to keep in mind is how the macro fundamentals are changing, whether there will be an interest rate increase, which is bad, will macro things change? Those are the that you need to keep in mind when you need to kind of trim out of the equity investments, right? But ideal time is when you see a downturn, and if you feel the macro environment is going to continue, if interest rates are going to be low, if the growth trajectory of the country is going to be still 5 to 6% plus, that's when you still keep on going at. So there's a question in terms of Cal has variable interest rates. Yes, unit trusts offer variable interest rates, but you mentioned here Cal has compound effect. So basically, even when I say 9.5 return, whatever, it's the return is accumulated on a day-to-day basis. For example, what you get on a daily basis is 9.5% divided by 365, right? So say, for example, if you had 1 million rupees today, that might be 1,020,000 rupees tomorrow. And that 20,000 grows to 1,030,000. On a daily basis, it accumulates. Compared to a bank deposit, if you say bank deposit at 8%, if you invest 1 million, it will only give you 80,000 rupees at the end of the period. It doesn't grow on that 8% on a day-to-day basis. And if you withdraw ahead of time, you get penalty on that 8% that you're withdrawing, right? So here, even if you withdraw in 2 days' time in a unit trust fund, you get that return that the fund has made for those 2 days. There's a question on gold index fund. Yes, something that we're looking at, something that is interesting and that we're looking at right now. So there's a question on dollars and what can you do with dollars apart from investing in NRFC or what you call as a personal foreign currency account. I think there are now, the government will come with a, what you call as a, they made the first announcement for a, what you call as, they're raising SLDBs or Sri Lanka development funds, which will be short in nature. I think there was an announcement for a $50 million, whatever. So question is what rates it will be, whether it will be better than them. But you now kind of starting to see investment products, particularly if you have dollars in the country, there are new options which are coming in. From the government side, I think there'll be dollar deposits or SLDBs which are coming in on an aggressive way in the next 6 to 12 months. So the one question is whether you keep money in a $4.5 deposit or units in other assets. Question is on currency depreciation. We feel the currency depreciation is not too much that we are going to expect. As a result, we still think the rupee investments can make a better return, but you need to be clocking in more than 10 to 11% returns to match against the $4.5 deposit. There's a question on commodities and so on. Still, framework is not there. SEC has spoken about it, nothing in paper. So you're not going to see that coming in anytime soon. But we are looking at products which can typically give you exposure to commodities in indirect ways where we create index funds and so on, which you can take exposure to. So this is the part that I was talking to you in terms of structured financial product. It's an array of things that we create for our clients, customized sometimes, and those come from time to time, which you can take exposure to. I think there's a set of questions coming, and given the interest of time, we will stop the session for today. But keep dropping in your questions to us. We'll keep replying to you, and hopefully we can have another session very soon. If of interest, please send in the questions ahead of time so that we can also incorporate your questions into our presentations as well. So with that, I'll stop the session for today. Retirement is not something easy. It's not something that you can just get over time. You need to plan for it today to achieve that objective. So start saving today to achieve that goal and optimize your investments to make that lucrative return over time. Thank you very much and see you on another session soon.